Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within financial filings. And today we're diving into Wheeler Real Estate Investment Trust's latest report. And let me tell you, it's got some interesting moves like a boardroom chess match with preferred stock and convertible notes. So what's the big news from Wheeler Real Estate Investment Trust, or WAL, as they're known on the stock market? Well, the main story here is about how some of their special kinds of stockholders are cashing out and how that affects the company's convertible debt. It's like a ripple effect through their financial structure. Let's talk about these 70% subordinated convertible notes due 2031. Now, these are basically loans the company took out that can be turned into shares of the company's common stock. Before this August event, the price at which these notes could be converted was around 2.82s for each share of common stock. That meant for every $25 of the note's value, you could get about 8.87 shares of common stock. That meant for every $25 of the note's value to get about 8.87 shares of common stock. But then something happened with their Series D convertible preferred stock holders. These are special shares that have certain rights like getting their money back or converting into common stock under specific conditions. On August 5th, some holders of this Series D preferred stock decided to redeem their shares, essentially asking the company to buy them back. Now, here's where things get really interesting. The price at which these Series D shares were converted was about 3.63 cent per share. Because of this, the company had to lower the conversion price for those subordinated convertible notes we just talked about. They adjusted it down to roughly $2 Arians per share of common stock. This is a pretty big deal because it means for every $25 Taiwan value, you can now get about 12.5 Taiwan shares of common stock. Instead of fewer, this is a 45% discount, basically making it more attractive for bondholders to swap their debt for stock. So how did they pay for these redemptions of the Series D preferred stock? They didn't exactly pull cash out of a hat. Instead, they issued new shares of their common stock. In this particular August redemption event, they issued over 41,10,000 shares of common stock to settle the redemption of about 36,000 shares of Series D preferred stock. Think about it. They are essentially trading this preferred ownership for common ownership. Let's look at the bigger picture for the Series D preferred stock. As of August 5th, the company had redeemed a total of over 1.6 million shares of this Series D preferred stock. And to do that, they've issued around 712,000 shares of their common stock in total. This means that for their Series D preferred stock, there are still over 1.7 million shares outstanding. And this isn't a one-off thing. The company has a rhythm for these redemptions. The deadline for the next batch of redemptions was August 25th, and the actual redemption date is September 5th. This implies a regular process where preferred stockholders can opt to get their investment back, which the company is handling by issuing more common stock. Now, a key piece of infrastructure supporting these stock issuances is that their registration statement for a large number of common shares became effective in June. This means they have the necessary paperwork in place to issue these shares, and they are indeed using it to settle these preferred stock redemptions, including for upcoming dates in September. It's like they've prepared the factory floor to churn out more common stock as needed. The company is also including a standard forward-looking statements disclaimer. This is basically a warning that their future predictions might not turn out exactly as planned due to various risks and uncertainties. They're saying that what they say today about the future might change, and they aren't promising to update everyone if things shift drastically unless the law requires it. Now let's put on our Warren Buffett hat and see what this all means for Wheeler Real Estate Investment Trust. The company is essentially managing its capital structure by converting preferred stock into common stock and adjusting the terms of its convertible debt. This can be a good strategy to simplify the balance sheet and reduce future interest payments if all goes well. The fact that they had to adjust the conversion price of their convertible notes downwards due to the Series D preferred stock redemptions shows the interconnectedness of their financial instruments. A key indicator here is the conversion price of the Series D preferred stock and how that impacts the convertible notes. When the Series D preferred stock is redeemed at a price that triggers an adjustment to the convertible notes, it signals flexibility within their capital structure, but also potential dilution for existing common stockholders as more shares are issued. The company's reliance on issuing common stock to settle these preferred redemptions is a clear sign that they are choosing equity over cash. This might be because they want to preserve cash reserves for operations, or perhaps they believe issuing stock is more favorable given their current market valuation. However, issuing more stock can dilute the ownership stake and earnings per share for existing shareholders. What's notable is the automatic nature of these adjustments based on the preferred stock redemptions. It suggests a predefined mechanism designed to keep the convertibles aligned with the market, but it also means the company might not have full control over when these adjustments happen or how much dilution occurs if the preferred stock redemption activity is high. Looking ahead, the ongoing redemptions of Series D, preferred stock and the resulting adjustments to convertible debt will continue to be a story to watch. The company's ability to manage this process efficiently without excessively diluting its common shareholders will be crucial for its long-term value. The strength of the company lies in its ability to adapt its capital structure, but the risk is that these adjustments could signal underlying financial pressures or a strategy that heavily favors a certain class of investors over others. We need to see if this deleveraging through equity issuance leads to improved financial health or just a different form of financial complexity. Alright, that's our breakdown of Wheeler Real Estate Investment Trust's latest filing. What's your take on these stock and debt maneuvers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.